Greetings, and it's time for our monthly inflation update. Inflation is all the rage in the media because certain items have been rising at a faster pace than normal, and the public is trained to be extremely frightened of all types of inflation, particularly in the US, to the point where a lot of things that are not even technically inflation are counted in inflation, such as stock market gains and things like that, but also a lot of bogus metrics that have been completely discredited still have somewhat of a cult following, such as the shadow stats measure that alleges that inflation has been growing at a double-digit annual percentage growth rate for quite some time, and that is obviously not true. So as you may recall, I put forth a metric of when I would consider inflation to be edging kind of high, and I described that metric in this video up here that you can see on the right-hand side. And that video describes how I need both metrics listed over here, the US CPI and the Goldman Sachs Commodity Index, to have a 10-year compound annual growth rate above 3% in each case. If only one of them is above 3% at a given time and the other is not, that doesn't count. I need both of these to be above 3% before I'll say that inflation is problematic. And getting close to these numbers is not a bad thing. Remember, this is the optimal amount of inflation. This is when technological progress is fast, because in an environment of too low inflation, technological progress is not as fast as it otherwise would be. So this is actually optimal. You want to get close to these metrics, and technology would progress even if it went above these metrics, but that's when there's also too much hardship for average people. So ultimately, this is what I consider the optimal amount of inflation. To understand why inflation that is too low is actually a bad thing and deflation is even worse, you must see this other video that I have up here in the right-hand side, because a lot of people have an oversimplified understanding of this subject, and they think all inflation is bad and all deflation is good because they don't think that their income can ever change. So they think inflation means they're just paying more for everything, and deflation means they're somehow paying less for everything. Never mind that their debt is going to crush them in a deflationary environment, and very few people understand that. So definitely see that video that I linked to just a few moments ago. So in this US CPI threshold, 3% 10-year compound annual growth rate. So we go over to the CPI first. This is the Bureau of Labor Statistics website. So you go over here to the Consumer Price Index and take this icon over here. And we are going to go to more formatting options, and then we're going to check off the following items: original data value, 6-month and 12-month change, in addition to the 1-month percentage change, retrieved data. So over here we have the actual CPI, and this is rising at a steeper rate certainly, but remember, a gentle exponential curve is what is to be expected because this is a linear scale, so even the same annual growth rate would show not a straight line but somewhat of a parabola. But it is rising somewhat, so let's see what's happening over here. So we have our calculator over here, and just like in prior months, we take the 10-year compound annual growth rate, which we do by taking this number and then the number 120 months prior, and then dividing the two and annualizing the gain. So we take this number, which is 282, divided by this number, which is 228, rounded to the nearest whole number. So 23.68% inflation over 10 years. Over 10 years. So what does that average out to per year? So you take the 1/10 root of that. This is the 10-year total amount of inflation. What is it per year on average? X raised to y, 0.1. I hope everyone understands the arithmetic of how that was done. So 1.02148. To find the actual percentage growth rate, you minus 1 from this and then divide it by 100. Okay, 2.148% has been the average annual growth rate, rounded down to 2.1. If it was a wee bit higher, it would be rounded up to 2.2. That'll probably happen next month, but 2.1. So 2.1 is the CPI annual growth rate. That is not even at the 3% level that I described before. That is, in fact, not anything to be worried about. Sure, the last 1 year has been a little bit high, but it's just offsetting the unusually low period of a year prior. You cannot look at this number without recognizing this number, and that's why you have to take the 10-year average. When you take, say, the 6-month chart, it's plateauing already. It's not rising anymore. It hasn't fallen down yet, but it's plateauing. One stock market correction, which is going to happen relatively soon because of the Federal Reserve tightening, will do it. And the 1-year annual growth rate, yeah, this seems very ominous, but it has to be viewed in the context of offsetting this and this. The average of this is about 2.1%. So this rise is all you hear about in the media. You don't hear about the average between this rise and this period immediately before because of COVID. And that's why I take a 10-year window of moving average for this. So now we go to the next metric, which is the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index over here. And it is higher than in prior months because oil prices have risen, as have natural gas prices. Remember, I said government incompetence can in fact always create inflation independent of any atom principles or anything like that. These get corrected over the longer term because of atom innovation and technological adaptations around the high price, but government incompetence can cause a rise. But nonetheless, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index is still negative. It's minus 0.46%. Minus 0.46%, which is not as negative as prior months, but still in the negative zone. Remember, it has to go to plus 3% before I say it's too high. So minus 0.46% over a 10-year period. Sure, over a 1-year period, the rise seems like a lot, but what about a longer window of time? 10 years, minus 0.46%. So then when we look at what both of those numbers were that we just saw against my threshold over here, 3%, 3%, what do we have? We have the CPI at 2.1%, rising a little bit from last month and the month prior, to be sure, but rising at a very slow rate. That's why that 10-year window is very important. And you have the GSCI at minus 0.46%. Again, less negative than before, but rising. And I actually want it to be close to 3% for both of these because that is when technological progress will move faster. But right now it is rising, and is rising for the wrong reason. It's not rising because of an excess of liquidity pumped into the system, but it is rising because of government mismanagement and incompetence based on all types of supply chain bottlenecks and problems, and an outright attack or discouragement of U.S. domestic oil production that has been engaged in. And it's not a partisan thing because, I mean, the Republican Party is someone that engages in the same thing. So both U.S. parties are incompetent. I'd say that is a fair view, but that is what we are seeing over here. So inflation has risen a little bit, but it's nowhere close to the thresholds that I have set before of 3% and 3%. And the Federal Reserve is already raising rates, and that is the problem. And they are going to cause a stock market crash, which of course causes inflation to fall substantially as well. And they will then be forced to lower rates again and print more money again because, as I describe in this video up here, the Federal Reserve does not realize how much money they will have to print since March 15, 2020 was the Netscape moment of economics. And this decade has to see $50 to $100 trillion of money printing because the prior decade saw 23 trillion. And the central banks of the world, the PhD economists, still think that they will undo the first 23 trillion and go to minus 23 trillion. That's what they thought at the beginning of the decade. And as you can see, their predictions continue to be wrong, but they don't revise their core assumptions because all of them have memorized the same outdated textbooks from the mid-20th century. That is why a lot of hardship is going to needlessly be caused to people that does not need to be caused. Anyway, this was our monthly inflation update, and I hope you found this informative, and I hope you found this to be a data-driven counter-narrative relative to everything you see in the media about how we're living in truly hyperinflationary times. And remember, the definition of hyperinflation is 50% inflation per month, not even per year, per month. The United States has never had hyperinflation or anything close to it. But anyway, thank you for watching.